Have you ever thought to yourself, man, I wish I could make money while I sleep?
Here comes the money, 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 money.
And everyone on the internet right away would start telling you, invest in real estate, buy a rental property, open an online business, start an e-commerce store. Of course, right after they try to sell you some kind of course on exactly how to do that. But let me actually introduce you to the most passive way to make money while you sleep. It doesn't matter how much time you have, how much money you have, where you're located at. In this video, I'll go over how to set up your first passive second stream of income for less than $100. I'll also go over how much money you can make from this, and you also never had to pick up a phone call at 2 in the morning because someone's toilet is all backed up and now your whole passive rental is completely flooded.
I am never going to financially recover from this.
And of course, I'll do all of that as soon as you sign up for my course with the link in the description below.
Buy my course. Topic. Buy my course.
Obviously, I'm just joking. Investing in the stock market is the most passive way to grow your money over time and receive a little bit of passive income on the side. Everybody knows that you have to buy the stocks while they're low and sell them when they're high.
You smart.
But what if I told you you can make money if the stock market is not going up, or even worse, if it's going down? I'm talking about dividend investing. Dividends is a small amount of money that companies pay, sometimes monthly, quarterly, or yearly, to the shareholders that hold their stock. And yes, you heard that right. Companies pay people just to hold their stock. A lot of the times the company makes so much profit, it doesn't want to reinvest all of it back into the business, so it gives a portion of that profit to us in the form of dividends. And one of the most famous companies that all of you have probably heard of is Coca-Cola. They have a 3.29% dividend yield, and they pay about 49 cents per share per quarter, or if we convert that to yearly, it'll be about $1.96 per every single share that you own. So in theory, if you had about 100 shares of Coca-Cola every single year, passively, you'd make about $196 on top of whatever movement the stock does, whether it goes up or down. And the most interesting part about dividends is that they're actually not taxed the same way that our normal income gets taxed. So for example, let's say that you're married and you made about $85,000 this last year. That would put you in the 12% tax bracket, and you would have to pay taxes on that earned income. But with qualified dividend, which is a stock that you held for about 60 days before the dividend declaration date, this is basically done so that you don't just buy a stock, receive the dividend, and then sell it off. If you do that, then your dividends would be taxed at your normal ordinary rate, which is 12%. But if you held the stock for more than 60 days, the amount of taxes due on those dividends is exactly zero. So not only is this investment strategy completely passive, you also get to skip out on paying all sorts of taxes to the government. And who doesn't love not giving our hard-earned money to the government? And the best part about dividend investing is the taxes are not the same as our earned income. If you make a lot of money, the maximum you can be taxed on your earned income is 37%. But with dividend income, the max you can get taxed on that is only 20% of your income. That's a 17% tax savings. Now that we know what dividends are and how they're taxed, let's dive into and look a little deeper into which stocks actually pay dividends. Like I said before, Coca-Cola, which has the ticker symbol KO, pays about 3.29% dividends per year. Bank of America, which has the ticker symbol BAC, pays about 2.64% per year. And I'm sure we've all heard of this one, Pepsi, with the ticker symbol PEP, pays about 3.01% dividends. And for those of you that want to dive a little bit deeper, TipRanks is a great website for comparing different dividend-paying stocks. So next time you decide to buy a coffee from Starbucks, maybe think twice about your decision and instead invest into the stock itself, because actually Starbucks, which has a ticker symbol of SBUX, pays about a 2.65% dividend per year. But what if you don't know what stocks to invest in? All these individual little stocks is just too confusing and too overwhelming. Well, don't worry, because I have a solution for you. It's called hitting that like and subscribe button, because the dividend yield you receive from that is well over 10%. But seriously, if you don't want to go to the trouble of comparing individual little stocks like Coca-Cola, Pepsi, Pfizer, or any other ones, or you don't want to risk all of your money investing into one single individual stock, then the best solution for you, and this is actually a strategy that I myself use, would be to invest all that money into an ETF. And to put it into layman's terms, buying an ETF is like going to the grocery store and instead of buying just one carrot, you buy a whole basket of vegetables. And there are several different dividend ETFs that you can choose from. My personal favorites are VYM and SCHD. And what these ETFs do is they only buy and hold the best dividend paying stocks, and they also look for the most consistent and companies that constantly raise their dividend, and they choose only the strongest performing stocks based on different financial ratios. So if a stock starts performing badly, or even worse, it completely cuts its dividend and stops paying it, that ETF automatically just gets rid of that stock completely and sells it from its portfolio, taking away all the hard work from you. Now, dividends isn't some kind of get rich quick scheme. You're not going to wake up tomorrow and be a millionaire. It takes persistence, time, and consistency to build a decent dividend paying portfolio over time. For example, if you were to invest about $10,000 in SCHD, which is one of my favorite dividend ETFs, you would get about 130 shares at the current market price. And then if you look at their $2.67 that they pay per year, you would get about $347.10 in dividends every single year.
Oh my God! Wow!
Or if we divide that up into months, that would be about $30 per month. Of course, that's nothing to write home about, and it's not very impressive, but the key thing to remember is you never had to work for that extra money. Now, let me share with you a little secret about dividends. You can take those dividends that you were paid out by the company and reinvest those same dividends back into that ETF or stock that you're holding under something called a DRIP. Which is a dividend reinvestment plan. That way, the next time you get paid another dividend, you have extra money in that stock and it would pay you even more dividends. And once you start that snowball rolling, it just compounds over time and you get paid more and more and more. And now let me share with you a piece of investing wisdom. The best time to invest was yesterday. The second best time to invest is today.
So just do it! Make your dreams come true!